The market is absolutely pumping today after the Fed addressed the public. Many investors are speculating that rate cuts will be coming soon, which has sent nearly every stock soaring into the end of the year. So in today's video, I want to go over the fundamentals of the market and how it is currently valued, so we can better understand if the market is overvalued or looking cheap today. Then I also want to share where I am personally seeing value and what I think could happen in 2024. So with that being said, let's dive right into the video. Let's head over to JP Morgan's Guide to the Markets, which gives us a lot of fundamental data on the markets today. So in this chart of the S&P 500, we can see that the index PE is sitting at 18.7, which is an earnings yield of about 5%. Now, bonds are currently sitting at 4.4%, which means that the earnings yield on the S&P 500 is higher than what bonds are currently offering. This means that investors are getting higher yields in stocks than in bonds right now, which, as the intelligent investor says, means that the market is not crazy expensive. For example, take a look at the year 2000, which was an incredibly expensive market. The price to earnings ratio was 25.2, which is a 4% earnings yield on stocks. At the same time, though, bonds had a 6.2% yield, which means that investors could get a significantly higher return risk-free by buying bonds instead of stocks. And in the intelligent investor, this would suggest that in the year 2000, stocks were not selling for a margin of safety. Moving on to the next chart, this one shows us what the one-year returns have historically been when the market has sold for an 18.7 price to earnings ratio. And we can see that the one-year returns following have been about 5%. So this is what investors can expect to receive over the next 1 year, which is not a very high return. Additionally, on this chart, we can see that the higher the multiple on the S&P 500 gets, the lower its future returns. And we can actually see that a price to earnings ratio of around 23 historically has had an average one-year return of 0%. And then above that, the average return goes into the negatives. So this chart right here clearly shows us that the lower the price to earnings ratio of the S&P 500, the higher future returns investors can expect. Now, moving on to the next chart, this one right here shows that there is a very large valuation spread in the S&P 500 right now. This means that some stocks are very expensive, whereas other stocks seem to be quite cheap or selling for fair value. We will also be taking a deeper look into this later on in the video, but right now we can see that there is a significantly higher valuation spread than the 25-year average. Moving on to the next chart, this one shows us that analysts are currently expecting about $275 in earnings per share for the S&P 500 by 2025. This means that analysts are also expecting around a 10% earnings per share growth from 2024 to 2025. So they are expecting some pretty strong growth to earnings for the S&P 500 over the next couple of years. Moving on to the next chart here, this one shows us that value is currently looking cheap in the market and value is selling near its historical average price ratios. We can see that they're at about 14.15x, whereas their long-term average has been about 14.09. So basically right at their historical averages. On the other hand, growth is selling 20% above its historical averages. So growth stocks do seem to be more expensive right now, and value stocks seem to be more cheap or selling near fair value at least. Moving on to the next chart. This one shows us that the top 10 stocks in the market are now trading 42% above their historical average price ratios. The remaining 490 stocks in the S&P 500 are trading about 9% above their historical averages, or are much closer to fair value. So the top stocks in the market are looking very expensive, and the top stocks are now also making up 33% of the S&P 500, which is at a 30-year high. So the S&P 500 is becoming more and more concentrated in a handful of stocks. The top 10 stocks are also providing 21% of the S&P 500's earnings. So their makeup of the S&P 500 is significantly higher than their actual earnings contribution to the overall index. Moving on to the next chart here, this one is getting more into the consumer health now. We can see that the savings rate for consumers in 2023 is below historical averages, so consumers are saving less money. Excess savings from COVID are also still declining, and they're down to about $1.1 trillion from their high of $2.3 trillion in 2021. I am not sure when or if this will turn around, but consumer excess cash has been declining since the massive stimulus back in 2021. All right, moving on. This next chart shows us the projected Fed funds rate over the next couple of years and over the long run. And we can see that the Fed is now projected to lower interest rates in 2024. And it looks like the market is expecting about 4.55% interest rates by the end of 2024. So it looks like rates are largely at their peak right now and will start coming down over the next year. Again, I also believe that this is why the stock market is rallying so hard today after the Fed gave their speech to the public and basically hinted that rates could be topping right now. Now, this next chart is getting into the international markets now and looking at how international markets have been performing versus the US markets historically. The US market has been outperforming for nearly 16 years now. However, there have been periods where international markets do outperform, and we could be entering another period where they do. This next chart shows that the all-world index minus the US is trading below its historical average price to earnings ratio. Also, the deviation between the US markets and the international markets is at a 20-year low now. This simply means that the valuation difference between the US and international markets is very wide right now. And remember the chart earlier where the lower the price to earnings ratio of the market, the higher the future returns? Well, the international markets relative to the US are trading for seemingly very cheap prices, which means they could offer higher future returns. The international markets also have a higher dividend yield right now, and are offering a higher yield for income investors. This next chart shows the 25-year average price to earnings ratio for different markets around the world as well, and then the current price to earnings ratio of those markets. And here we can see that the US markets are selling well above their 25-year average price ratios, and that every other international market is selling below their historical averages. Japan, Europe, emerging markets, and China. And China is looking very cheap at only 9.5 times earnings, which is also an over 10% earnings yield. So it does look like there could be some significant value in the international markets right now, especially relative to the US markets. What's also interesting is the Asia Pacific region of the world is projected to add over 1 billion people to the middle class by 2030. This is a huge amount of labor and economic stimulus, and should provide significant growth to this region of the world over the next decade. To put this in perspective, North America is projected to add only 8 million people to the middle class, and Europe is projected to lose 1 million people. So over the next 7 years, the growth to the middle class is largely going to be coming from Asia and India and China in specific. Now let's discuss where there could be value in the markets today. The S&P 500 again is trading for that 19 times earnings today. And as you can see, it is above its historical averages. Now, if we take a look at the S&P 400 mid-cap index, we can see that its price to earnings ratio is 13.9 today and is below its historical averages. So it looks like mid-cap stocks could be offering discounts right now, especially relative to large cap stocks. Now, if we take a look at the S&P 600 small cap index, we can see that it is trading for a price to earnings ratio of 13.4 today, and it is trading well below its historical averages. So small cap stocks do look like they are trading for quite the discount right now relative to large cap stocks and also relative to how they have traded in the past. But overall, it does look like mid and small caps are trading for discounts and could be providing more value than large cap stocks in the market today. It also seems like investors have kind of fled into large cap stocks, and specifically the leading US stocks like Apple, Microsoft, and Nvidia. And if we head over to Stock Unlock, we can take a look at Microsoft as an example here. So Microsoft is now trading for a price to free cash flow of 43.6, which is a free cash flow yield of only 2.3%, which is not a very high yield at all. Bonds are offering a significantly higher yield than Microsoft now, which suggests that the business is selling for no margin of safety. Over the past decade, Microsoft has also seen its price to free cash flow compound at roughly 16.5% annually. Now, if we add in some more metrics here like the stock price, the free cash flow, and the shares outstanding growth over the past decade, and then scroll down, we can see that the stock price has returned about 27% annually over the past decade. The price to free cash flow has contributed again about 16.5% annual returns to that. The free cash flow growth has contributed about 8%, and the buybacks have contributed about 1%. This means that the vast majority of Microsoft's returns over the past decade have come from multiple expansion and not underlying fundamental growth. Its free cash flow has grown again at 8% per year, but this has not been where the stock price returns have come from. They have mostly come from, again, the price to free cash flow expansion. Or, in other words, the stock has been running much faster than the business has been able to grow. Now, this cannot continue on forever, because if Microsoft's multiple continues to expand at 16% annually, then by 2033, it would trade for a price to free cash flow of 192. So at some point, the multiple expansion has to stop. And when it does, Microsoft's returns will match its underlying fundamental growth unless we see some multiple compression, which means that the stock price will actually return less than its underlying fundamental growth. Ultimately, this means that at some point, Microsoft will not have the tailwind of multiple expansion propelling the stock higher and higher. So my expectation is that some of the more expensive stocks in the market will see lower future returns than they have seen over the past decade. Apple is another great example of this. We can see that its shares outstanding have declined by about 4.8% annually, its free cash flow has grown by about 7% annually, and its price to free cash flow has grown by about 9%. So this is not nearly as extreme as Microsoft, but we can see that multiple expansion has been where the largest returns have come from for the stock over the past decade. Apple is also trading for a price to free cash flow of 30.4 now, which is a free cash flow yield of about 3%, which is still below bonds and suggests that the stock is not offering a margin of safety for its investors now. So in my opinion, what I am expecting for 2024 is probably a slowdown of growth to the top leading US stocks like Apple and Microsoft, because these stocks do seem to be quite expensive now. We also saw that there is a massive discrepancy between the valuations of the top 10 stocks in the market versus the remaining 490 stocks. On average, the S&P 500 doesn't seem to be that expensive today, but there is a handful of stocks within there that do seem to be very expensive and selling way above their historical average price ratios. What this ultimately means is I think that 2024 is going to prove to be a stock picker's market. If you are someone who knows how to analyze stocks and find value, then there is still value out there, and these value stocks could provide higher returns than the overall market and the top stocks within the market as well. Additionally, it does still look like mid and small cap stocks are undervalued and offering discounts. So these could be areas of the market to search for undervalued stocks that could provide higher returns going forward. And on my channel, I do my best to find these undervalued opportunities and find stocks that could be offering higher return potential than the overall market and the mega cap stocks in the market as well. So if you want to stick around and see more content like this, then please make sure to like the video and subscribe to my channel. I am also doing a YouTube portfolio challenge to see if I can pick individual stocks and outperform the S&P 500. And since the inception of this portfolio, I have been outperforming the S&P 500 with overall returns of 41.6% now versus the S&P's about 23%. And since I believe that 2024 will be another year of a stock picker's market, I am expecting to continue outperforming the S&P 500 in 2024, as I do think that its higher concentration of the larger cap stocks could reduce its returns in 2024. But that is just my speculation, and who knows if I will turn out to be right. But if you want to follow along with my stock picking portfolio and the YouTube portfolio challenge, then again, make sure to subscribe to the channel, because I do plan on doing monthly portfolio updates for the YouTube channel and discussing where I am buying stocks, what stocks I am buying, and where I am seeing value in the market. But with all that being said, that is going to wrap up today's video, everyone. So thank you so much for watching. I truly do appreciate it, and I really hope to see you all again in my next video.